So thank you for the introduction. I won't go through it again, although we'll just quickly, I think it would have been more useful if we sat under our pictures, but never mind. We can all figure it out. We've already been introduced, so I think we should just crack on, get right into the heart of it. I mean, geopolitics of the topic itself is, I think, key at the moment because everyone is talking about stablecoins. US Treasury Secretary Scott Bessent, any opportunity he has, he brings up stablecoins and the role they're going to play in maintaining US dollar dominance. And I think over the time that I've been looking at stablecoins, especially the last year or so, people, especially regulators and policymakers, I think they've become more and more explicit about their fears that stablecoins could be used as a mechanism to enforce dollar dominance and other sort of fiscal. I think another trend is also just the degree to which stablecoins might allow treasuries and finance ministries to take control of monetary dynamics. So that's something I've witnessed myself, but you guys are the experts, and I thought the best place to start perhaps is with Nicola, because today is also Sintra, which is the ECB's annual meeting. And everything okay? Yeah. And I think the Europeans are, I think it's fair to say, the most cynical and sort of anti-stablecoin out there in terms of jurisdictions. Why is that? What's your insight? Because you come very much from the European perspective.
So thank you very much. Very nice to be here. This is a very good question, right? Because if you read Madame Lagarde's speeches, right? At the beginning, once she was speaking about the digital euro, Pontes and Appia, that you are probably all familiar with the projects, right? She was kind of thinking that those three infrastructure could somehow mitigate the risk stemming from stablecoins, right? And then eventually, a couple of weeks ago, she actually delivered a speech where she was criticizing quite explicitly, stablecoins. And if you think about all the discussion that we had in the past month, there was clearly a clash between the European Central Bank and the European Commission, where basically you spent 3-4 years working on the MiCA regulation. You have spent 2 years of provisional implementation of the regulation with national supervisory authorities investing resources, expertise, time on training their people. And that is what we do at FBF actually. So we touch with our hands how national supervisory authorities are working to try to understand how to implement MiCA. And then eventually, after years of resources, the ECB tells the Commission, okay, maybe MiCA is not framing correctly the risk stemming from US-denominated stablecoins, right? So we need to revise the rules. So even though MiCA was not implemented, they were already thinking about MiCA 2.0. And I think that is clearly an issue when we think about how the European Union works in terms of regulation, because you have different institutions trying to shape the policy discussion. But generally speaking, I think there is a concern within the European Union that stablecoins could somehow replace sovereign money. And I always ask my fellow colleagues and say, okay, what is the use cases? Because we need to think about use cases, right? As a European Italian, you can clearly hear from my accent, why should I use a US-denominated stablecoins to pay? I have very efficient means of payments, right? So it's not about the retail side that the risk is stemming from, but maybe it's coming from the wholesale side. And then you have Pontes and Appia that can provide a public infrastructure for private industries to experiment around tokenization and stablecoins. So I think like for the ECB, the idea is try to demonize somehow private initiatives to promote a public infrastructure. Because in the end, the issue is not about the infrastructure that you're using in my perspective, at least for European policymakers, but it's about the money that you're using. And if you're using Pontes or Appia, we don't know what it is, but eventually, you were using public money. So you're using a public infrastructure with like private tools. And I think this is the kind of compromise that the European Union is trying to promote, to have a sort of balanced approach.
I mean, just whilst we're on the topic still, there is a sense, I think, in Europe that strategic autonomy is now very important. And in this case, specifically, I think there is a growing antagonism towards Visa, the dominance of Visa and MasterCard, right? So do you think that would have been the case even outside of a Trump administration, or do you think it's specific to the politics that we're seeing in the US?
So if you look at the ECB publications, European Parliament publication, etc., there is an increasing awareness about the dependency on Visa and MasterCard since COVID, right? When you had a cashless kind of increased in terms of trends in the European Union, and the European Union started thinking about strategic autonomy in multi-dimensional fields, right? And you realize that basically only 13 out of 27 UN member states have a national card payment system, right? So the other countries do not even a domestic system. And this clearly is a vulnerability. Despite the Trump administration, that is a key vulnerability. And again, I think the digital euro project, for example, is not about stablecoins, right? It's just about providing an infrastructure that is alternative to Visa and MasterCard. And to me, I even don't think that the ECB is that concerned about the adoption of digital euro. I think for the ECB, the idea is we're investing money, resources, to create a parallel infrastructure so that in case, right, very, very, very hopefully, very, very long-term scenario, there is any issue with the US administration and they decide to plug out European countries from the Visa and MasterCard circuit, you have an alternative that you can put in place. What happened to Russia? In Russia, right? Visa and MasterCard pulled out from the Russian market, but Russia had a domestic payment system and that could, maintain operations. So I don't think digital euro is about stablecoins at all.
Isadora, you're nodding furiously.
Furiously. I mean, yeah, I wear different hats, right? Hedera is mostly about the infrastructure. We're not an issuer. So, but I'm also doing a fellowship on geopolitics. So these topics fascinate me. I guess it's really important to differentiate the questions about the underlying infrastructure, which I've always seen the digital euro as a project that helps advance. As Nico was saying, like the European payments infrastructure that has kind of failed. And actually, despite domestic payments being quite fast and quite convenient in Europe, it's actually quite difficult to pay across borders within the euro. And so that's kind of a project in and of itself. And then the stablecoin issuer as a separate kind of business model and kind of risk profile is a different consideration, which Mika tried to address, right? Although protecting the banking system because of the kind of banking sector's role in the European economy. I think in the UK sits in a very different position to the EU as it relates to how it has considered issues around stablecoins, but I think every single jurisdiction is kind of thinking about, the kind of the trilogue of national security, macroeconomics, and kind of the future of money together. I think it's very difficult to decouple those kind of priorities when it comes to designing stablecoin regimes, because the reality is that we do live in a world where where the foundations of kind of like the Bretton Woods system and the things that underpin the kind of world trade order have changed, right? There's shifting sands, and stablecoins are part and parcel of that discussion of how that future is reimagined, I think. So Europe is in a very, very peculiar situation because, as Nico was saying, it doesn't actually have the infrastructure it needs to kind of feel resilient. And it wants to both kind of maintain and support an innovative environment, but it kind of has a more kind of like public sector stewardship mandate, I guess.
So whenever I talk about, whenever I raise the fact that the Europeans are very anti-stablecoin to sort of macro analysts, they immediately say, well, that's understandable because Europe has a fragmented bond market. And this explains why their preference is for creating a CBDC, because it's going to be much easier to control. Do you think, and it's an open question to any of you, what role does that play a role in their thinking? Anyone have any views?
So do you mean the consolidation of kind of like a fiscal union versus?
Well, in that stablecoins obviously have been put forward as a mechanism that can allow governments to create demand for their bond markets. And in Europe, due to just general kind of fragmentation of that bond market, there are fears, perhaps, that one bond market will dominate over the others and then undo or undermine ECB policy. Or the ability to maintain a cohesive sort of regime.
So I'll let others comment because we've been dominating the conversation, but I see that the European policy perspective on stablecoins is inward-looking. It's not about kind of the euro's role internationally. It's not about kind of like, demand for euros across borders. It's about kind of like welcoming clarity within the digital assets ecosystem and digital euro. It's about the payments infrastructure that underpins the European market. But others might have different views on.
Jana, perhaps they bring us into, we were talking about the role that Cavalis is playing here geopolitically as well, and they're one of, well, I would argue they're the biggest sort of euro stablecoin that is forging in the market. But what is their sort of perspective?
I can't speak for, I've got so much to say. I can't speak for Cavalis, obviously. This is based on observations of, their various announcements lately and things like that. And, this is very much building on some of the points that others made. First of all, in terms of backing assets, I do think that that is a challenge for European stablecoin markets. And every regulatory regime reflects national priorities. So if we look at the UK, particularly on the systemic side, it's very much been about the continued role of central bank money in, preserving the singleness of money and preserving that integrity across the financial system in Europe, partly probably due to the fact that there's a fragmented national bond market. It's difficult to have to have a backing asset regime that encompasses just lots of European bond issuances. It's more complicated to manage, and partly because of that, partly because the first iteration of MiCA was basically designed by the banks, since they were the only ones with policy voices in the room at the time. MiCA's regime for tokenized e-money stablecoin backing assets is very much set up to favor the commercial banks. So it's all about commercial bank deposit backing. That said, as I was talking about the inward-looking, aspect of Europe when it comes to the euro and not looking at the global stage. And this is where, first of all, on the one hand, we've got the ECB being vehemently against stablecoins. On the other hand, we've got 37 European regional banks getting together, and that's grown very rapidly from, I think, 12 to 37, probably going beyond in the near future. New ones seem to be joining all the time. Who are actually seeing the value of stablecoins in the European monetary ecosystem. And not only within the borders of the Eurozone. So Cavalis at Point Zero Forum last week actually announced some work that they're doing. So their head of APAC partnerships, who's actually based in Hong Kong, really interesting for a Euro stablecoin issuer. So they're doing some work with partners in South Korea and Japan using the Cavalis stablecoin. And he said originally they'd thought that this was all about Euro 1, Euro yen corridors, but actually interest has been expressed on using the Cavalis stablecoin to bridge from those jurisdictions to LATAM. And so why, you ask, would we want to do this? And I know, Isabella, you had some wider thoughts on exchange rates and this, but I think it's part of this global picture as well, which is, why do people want to move away from using dollars? It's not just a dislike of dollars. It's the reality of, first of all, sanctions, and secondly, tariffs at the moment. So on the sanction side of things, Nicola has already discussed the weaponization of US sanctions on the global stage. We're now seeing Europeans like the members of the ICC who are just doing their job, who are now sanctioned by the US for politically motivated reasons and are unable to access European banking services as a result of that. So this is a increased driver of exploring greater monetary sovereignty globally as well. The second is tariffs and what's been happening with the US as a trading partner and the kind of uncertainty that tariffs have created over the last few years. So increasingly jurisdictions are looking at opening up new trade corridors from a regional perspective. So we're seeing the growth of intra-African trading corridors. We're also seeing the growth of African-Asian trading corridors, etc. And so more of this regional development, and obviously with the Cavalis announcement, this interest in LATAM, Asia as well. And the reason for that is to enable greater trade between those jurisdictions, but often the current correspondent banking system isn't well set up to support settlement across those jurisdictions very efficiently in a very cost-effective manner. And this is where stablecoins can play that kind of leapfrogging role in building better infrastructure and at the same time kind of moving to a more multipolar international financial settlement system.
Given that given that there is this huge opportunity and that the ECB is trying to push for the international role of the euro, why the hostility then, do you think, towards Cavalis and stablecoins more broadly?
I honestly don't know. Maybe the Europeans here have more of a view on it.
I think, again, is about the nature of money, as you said, right? So I think, at least like talking to my fellow friends at ECB, etc., they are very concerned about losing control over money creation, right? So I think, in my perspective, both Digital Euro, Pontes and Appia, and I hope you're all familiar with Pontes and Appia. I know it's a bit of a nerdy kind of field, but
maybe
basically,
fill us in just to make sure.
So basically, Pontes and Appia is the roadmap for a wholesale CBDC. Let's call it this way, even though you can argue that wholesale CBDC already exists, whatever. But basically, Pontes is the short-term project that should be launched actually in a few months, and is trying to connecting within the TARC system with a new cash leg, which is DLT based, right? So you have the infrastructure that now exists, and you are creating an additional cash leg where you can, try to experiment through tokenization and through the DLT technology, right? Appia is the long-term project. I think should be out in 2029, if I recall correctly. And it's going to be, we don't know the details, but a native full DLT technology. And if you look at Pontes, is only targeting the intra-European market. While Appia, if you read the roadmap and the publication about it, they are aiming at creating also a cross-border dimension. So the idea is try to use Appia, to be interoperable with foreign systems, so that potentially you could reduce cost, speed, you can increase the speed of transaction, and this supposedly could also incentivize the international use of the euro in trade transaction and settlement, for example. So I think the plan of the ECB is trying to provide to private actors a public infrastructure, right, which is technologically speaking advanced. I don't know if in 2029 it's going to be advanced, because again, I saw the question and indeed it's very slow, but for DCB time it's quite fast if you think about it. So that you can use public money, because the final liability you would use is a central bank liability, okay? It's not going to be a private kind of stable coins, right? So I think for DCB, the idea is I provide you guys from the private market the public infrastructure. Through public money, you can experiment, you can develop solutions, services, products, whatever you want. But in the end, the final liability you're using is mine. I think that is at least my perspective.
It's sovereignty, which brings us to the most interesting element. I'm sorry I've left you to the end, but I think this is the natural flow of the conversation. Africa specifically has been dealing with this sort of dollarization issue for a very long time. So what opportunity is there in terms of utilizing home currency, stablecoins, in sort of establishing monetary sovereignty in a more concrete way? And how do you see, what's Africa's perspective on that?
So I think Africa, comes from an unfortunate history of colonization. Traditional banking systems just weren't set up, with Africa in mind. We're always priced as, one of the riskier kind of areas to even do business. So, as Jana said, from a cost perspective as well, we get the highest kind of rates of transaction cost. It goes through a correspondent bank to New York or London and then comes back to Africa, and it's just not cheap. So for us, stablecoins present really the opportunity to get something that's quick and cost effective. A lot of Africa, a lot of the population in Africa, they're unbanked, which is why mobile money in Africa has taken off so well, right? Because it's really just servicing people with basic everyday needs. The Western financial banking systems here are sophisticated. Back home, it's not the same. And also when you think about cross-border trade and remittances, those are really the use cases that you find Africa sort of just reaching for the dollar. So for me, I think for us, the sort of dollar demand is really, it's kind of historical in the sense of the fact that a lot of our debt is dominated in dollars. Credit that we get is also dominated in dollars. A lot of the economies are more import-led than export-led, which naturally lends itself to very volatile currencies. So in Africa, aside from cross-border trade, remittances, people also use it as a store of value. So there is this proliferation of US sort of stablecoin, US dollar stablecoins. But for me, I see it less as a sort of predatory because it is a signal in terms of what is actually structurally needed on the ground. And for me, I think one of the ladies on the other panels had talked about a sort of multi-currency, multi-layered monetary system, and that's how I see it. I don't think we need to say, US dollar stablecoins are terrible and no one should use them. I don't think that's really the goal. The goal isn't to ban. I think the goal is to really understand what's happening on the ground, what the needs are of the continent and the country. And because Africa is so fragmented, every country has different sort of currency volatility needs and whatever it is. So I think the fact that we are reaching for US dollar stablecoins is more of a signal in terms of what we actually need in terms of the banking systems, remittances, and things like that. But local currency stablecoins, for me, should be the natural path that we are kind of moving towards. And we already are. There are about 7 to 10 local currency stablecoins currently on the continent, sort of spread across at different adoption rates. And I know the argument is typically the adoption rates are low. If everyone wants US dollar, why bother? But I think it goes beyond that. I think if we don't give people an alternative, if we don't give ourselves a choice, an alternative, then we're just defaulting to US dollar. And I don't think it's specific to Africa, as you can tell. Europe, LATAM, Southeast Asia, everyone's going through this whole dollar dominance conversation, right? But I think it's particularly important for Africa to be able to, I think, look at it more from a continental perspective as well, because the dollar really is strong because it has a network. Everyone uses the dollar. And I think for Africa, because we are so fragmented, we need to sort of look at it from a continental sovereignty perspective as well as a national sovereignty perspective. And if you are able to have things like programmable money that gives you more control over how things can be tracked, credit worthiness, and things like that, it just gives us more control over our own currencies, whether they're weak or not. I think there is work to be done to strengthen the local African currencies, don't get me wrong. I'm not going to sugarcoat it. But at the end of the day, the sovereignty is ours. Whether the currency is weak or not, we need to provide those alternatives, especially for intra-African trade. At the moment, we have a Pan-African payment settlement system, which basically is at the wholesale central banking level, and I think there are 12 central banks signed up to that, which allows for the central banks to settle directly in the local currencies. And I think having the local stable coins or wholesale CBDCs, whatever it is just really the layer on top of that to just help promote and push this. And I feel like there was, I think one of the Bank of England ladies had mentioned velocity. So the local stable coins, they look at sort of the supply and the adoption, of them, which is slow because they've only just started. But you've also got to look at the velocity. How many times does that one stablecoin get used over and over again? And if you actually look at the Nigerian local stablecoin CNGN, the velocity rates are high. So, I think every sort of nascent monetary system or, forming monetary system started at this very point that Africa is starting at. So for me, it's encouraging to see local currency stablecoins, which give people an alternative. And I do think there is a real use case for them. I just think, adoption is slow. We need to strengthen the currency. We need to gain confidence. There's that trust deficit for sure that needs to be fixed. But I think, if if we don't do something about it and give an alternative, then we will just default to the dollar, which I don't think is, we'll wake up 10 years from now and we're still in the same place, which I would hate to see for Africa. We are such a resource-dense, mineral-rich continent. Everyone comes to us to extract our goods, our resources. And I think for me, that needs to just stop. We need to stop being import-led. We need to export more. We need to refine. We need to promote local manufacturing. And these are some of the things that will naturally strengthen, the currencies. In Ghana, I guess it's been a little bit of a loophole in the sense that the price of gold has gone up, but we have managed to strengthen our currency because we're able to buy the gold locally and obviously sell it on the foreign market for a higher price. And yes, it's a little bit of a hack, you could say, because the gold prices are higher now. But, these are some of the things that the governments are thinking about in terms of strengthening the currency. And I know the the South African Reserve Bank governor, he has also said that is something he wants to do in parallel to looking at local stable coins. And he absolutely, I think, doesn't even want to think about retail CBDCs. But I think everything has a use case, and I think slowly, if structured properly, we can get there. And I think tokenization is also going to be key for Africa, because that fractionalized ownership for people who don't earn a lot, still want to have access to international financial markets, it just presents them with that opportunity to participate in the global finance sort of market, which is really where I'd like to see Africa get to.
Correct me if I'm wrong, but obviously, I believe the Inera was one of the first CBDCs out there to be functional, but it hasn't been as popular as maybe the central bank had hoped. So
yeah.
Is it the case that the local stablecoin alternative is proving more popular than that initiative?
Yeah, I think, in terms of retail CBDCs, I think globally, even if we look at the sort of the e-yuan, the one the Chinese issued, adoption is low there too, even though it's backed by the state. So I think there is a general kind of fear of being tracked, monitored. Obviously the central bank can freeze the assets and, all of those concerns. So I think adoption generally has been low. There was also an e-city in Ghana that was launched in 2021, and that was slow as well. I think Ghana is thinking of relaunching that now. And I think it's more to give people who are unable to access certain, have bank accounts, be able to sort of a financial inclusion play. But I think, it's a tricky one when it comes to retail CBDCs. I think globally, adoption has generally been low, and even more so for African economies where the currency is volatile. So.
Just to add to that as well, like in the case of the e-Naira, the Nigerian government was very quick to rush it out, and to some extent it was a response to the growth of crypto use. But one thing that they didn't really do was test local appetite, test use cases and things like that. It is in its next incarnation now, where the infrastructure is being transitioned from retail to more wholesale, and that's expected to have better adoption and play a more foundational role in the ecosystem. But one of the reasons, as Mimi alluded to, for which there hasn't been high adoption of local currency stablecoins domestically, although the potential for cross-border is higher, or for retail CBDC, is actually the prevalence of mobile money. And so 1/3 of the money in circulation is actually mobile money, which interestingly creates a different kind of policy perspective on all this, because you've already got, it's basically regulated e-money that's issued by telecoms companies. So this is already like non-bank issued money. And mobile money providers are not only, having mobile money in circulation, they're also providing other financial services. They're, providing lending and things like that. It's fully backed lending, but from liquidity providers. And so there's now more of an emerging policy debate on the extent to which, mobile money providers should be allowed to become banks, for example, if they're filling a role in the ecosystem. And stablecoins are just the tokenized version of that already circulating mobile money, with the potential that the infrastructure can provide to deliver all the the additional kind of value add financial inclusion services that Mimi mentioned.
I think it's a really important point. Certainly, I agree. Mobile money is in many ways a proto-stablecoin, but also this sort of network of agents and distribution points that comes with it is very empowering to any company that is operating there. And I always find it, I did find it quite interesting to learn that Tether says at least that it has a similar network of agents across lots of different markets, but also in Africa, as far as I understand, and that they want to tie it with sort of providing battery services or solar-powered sort of opportunities and other, I don't know what else they're selling there, but they referred to it as sort of having boots on the ground, which I think is fascinating from that perspective. Is that welcome, do you think? And is that how the marketing element gets out there?
I am very wary of just foreign operators in Africa generally, just because typically they just come to extract. And I think when you look at the different US dollar issuers in Africa, Tether is definitely the top, and then Circle. And I think, naturally there's the demand for these US dollar stablecoins, so I don't see an issue there really in terms of them operating. But I think really what the local regulators need to do is to just get a good handle on, the volumes and be able to put certain caps on what exactly they're doing within the continent and which countries they're operating in, because at the moment a lot of the regulations haven't made anything or haven't explicitly said how they will regulate foreign issued stablecoins, including the likes of Tether and Circle. But I think in terms of how it's received, I mean, obviously there is the natural demand for it. So as far as the youth and the people, the tech savvy people who use all these things, they will embrace it. But I think it's down to the sort of regulators and the policymakers to make sure that there isn't a proliferation of it and it's kind of further eroding the monetary sovereignty of African countries. So yes, we do embrace it to a certain extent and it's received, but it's because at the moment there isn't any real alternative. The liquidity with local stablecoins at the moment is quite thin. So till we are able to build those trading pairs and there is liquidity and then also interoperability across the continent, which will really help with the sort of continental effect that I was talking about, until those things are in place, it'll literally be sort of one nation and then another nation sort of looking at it separately. And I think that's fair and fine enough per nation, but I think really if we want to sort of look at Africa as a whole, it has to be a continental effort and effect across the board. And I think for me, just selfishly, I want to see the local players win. I want Africa to take control of its narrative. Nigeria is the second largest adopters of crypto globally after India. That's a story, like that in itself is telling you a story. It's there. The people know how to use stablecoins. They're not illiterate to the point where they don't understand it. It's there. Yes, it can be built upon in terms of financial literacy and all of that, but we get it. Africa has the youngest population globally. So we are at the forefront and the frontier of this technology and being able to build it for ourselves. I think the question really is how quickly can we build it? How quickly can we regulate it to be able to take advantage of what's happening? Are we going to sit back and then, 2 years later, it's kind of moved on too much?
Exactly. Absolutely. I'd like to invite, we've got 10 minutes for questions, so please submit them through the app, I believe it is. But whilst we're just collecting those, I wanted to ask a little bit, I wanted to get your thoughts on the recent sort of weaponization of the dollar through stablecoins. I think one of the reasons people have flocked to stablecoins, especially in sort of developing markets, is the perception that they were of the dollar but not part of the system. And yet now we've seen Tether very much move in step with whatever the US administration says, freeze all sorts of assets, whether it's in Iran or with Maduro. Does that change things, do you think, for the dollar?
Yes.
And yeah, go on.
Yes, I do think so. You know, as I said earlier, this is partly a story about sanctions and partly a story about tariffs. I think this is now, you know, an incremental story as well. You know, we've seen. I read a great book recently. It's called Underground Empire, and it's basically about this whole narrative, this whole story of, you know, how the U.S. gained its not only financial dominance but its tech dominance essentially as well, and it's the incremental control over the financial system that's grown over the years, which is fine when, you know, when there is a multilateral world order, you know, there's multilateral institutions, there's a sense of fairness and justice. When you're not quite sure how the dominant player is going to react in any given situation, and there's a growing politicization of the power and the tools that they have, then that, you know, leads to this additional uncertainty, and therefore, you know, an announcement like we intend for, you know, the explicit intent behind US stablecoin policy to, first of all, create greater demand for US government debt, and secondly, to cement and, you know, further entrench the dollar's dominance as the world's reserve currency, if not expand it, because there are these greater expansion opportunities in emerging markets, given their ability to circumvent currency controls at the moment and things like that. That, you know, really sets off alarm bells in many jurisdictions. For many reasons, the economic sovereignty level, as well as that kind of, you know, underlying tech and financial sovereignty. How much control do we actually have of the way that our citizens interact with each other, pay, you know, for goods and services with each other? And additionally, I think the important thing is, if you've got a foreign issued stablecoin circulating in your jurisdiction, what recourse do the holders of that stablecoin locally actually have in the event of anything happening? You know, it's, if you're a jurisdiction that doesn't actually have the corruptive power, like, you know, say the Bank of England does, to be able to have those negotiations with other jurisdictions on, you know, mutual or unilateral recognition, then you are a taker of whatever, you know, is imposed on you by foreign issuers who are acting as agents of foreign governments, essentially.
Isadora, any thoughts on the weaponization?
Yeah, I mean, I think it's a trend that has been happening ever since kind of like post 9/11, really, like with sanctions, with, you know, with the war in Ukraine, like different ways of exposing vulnerabilities of the interdependencies of the global financial system. So yeah, echoing what Jana said, I think we tend to kind of, I think we've just come to the understanding that the dollar is as dominant as it is. So I think like when it comes to actually worrying about its kind of like expansion, it is the reality that is kind of the world's reserve currency, and that it does underpin capital markets, right? So to Emma's point earlier, we're not necessarily doing a change of the status quo. I think what's happening is kind of like a loss of trust in the system. But I do think, you know, geopolitical uncertainty is a fixture, and it's something that, you know, happens throughout decades. And what we need to start thinking about now is a template for global cooperation, right, and for global coordination, because these developments are going to move faster, and, you know, regulatory capacity and oversight and supervisory dialogue is kind of going to be fundamental to maintaining global financial stability. So I think politics, yes, it's accentuated some of these trends, and yes, it's kind of accelerated some kind of projects both on the protecting monetary sovereignty and protecting infrastructure sovereignty. And I think that means that we are going to see some undoing of interdependencies. But I do see that there is kind of a willingness and an understanding of the importance of cooperation in this context, because it's in everyone's interest. So I think we will see kind of like a fragmentation. If you think about when SWIFT was created, it was off the backdrop of kind of like the competition of currencies, and Citibank bank trying to come up with a messaging system for the world, and you know, the Europeans freaking out about having an American bank, and then you had kind of a template for collaboration again. So it follows kind of, I think there's ebbs and flows to this kind of reordering of international relationships. I don't think it's you know, specific to this administration, although it has obviously accelerated it, and especially because it's been laid bare so explicitly, right, as a kind of as a political ambition and mandate.
So we've kind of touched on the questions we've got here from the audience. So I'll leave. Is 1 minute left. Good way to finish is if the dollar's not, if US stablecoins are not going to liberate anybody, if local ones have liquidity issues, and to be fair, like even the euro is also, you know, there are sanctions questions over that as well. What is the alternative? Is there perhaps the potential for something like a gold-backed token money to come back into the frame? That's my last question. Quick thoughts.
Yeah, so Africa is exploring that, specifically Ghana, and there's Ubuntu as well. I think that's kind of Pan-African. So we are already exploring that, and that makes sense because, you know, we do produce a lot of gold, and it's something that's in the pipeline. So there's a company in the regulatory sandbox for VASPs currently that is looking to launch a gold-backed stablecoin. And I think this is great because, you know, it's really the biggest competitor to the US dollar gold, really, right? Because of its scarcity element as well. And I think for Africa specifically, it kind of means the fragmentation issue that we have kind of gets taken off the table to some extent, because gold is universal. It can be used across the continent. We don't have to kind of have one currency that we all trade in. So for me, I'm hoping that's really the direction of travel, and that becomes successful across Africa.
I think you've had the last word there, so thank you very much, everybody.